how is this going to make my money perform compared to my alternatives? And so that's the lens we'll look at it at through these case studies. Perfect segue though, as we start to get into some of these numbers, you all have probably seen this before when we talk about financials and we talk about investments. The big key here is that investors should do their own due diligence. So I would encourage all of you to do your own due diligence. Of course, what we were talking about are estimates and are not guarantees. And there's a whole lot that we, I think, just should adhere to as responsible adults before you're going to make an investment decision. Make sure you do your due diligence. And we're here to help, but this is not financial planning advice. It's on you, as well as your support network, to get you to that place that you should be confident to invest. So with that being said, let's jump right into the case study here. And so I wanted to kind of take a leap from the theory of like, how do we move this money and what's possible, to like what this is actually doing for real life clients who have done a similar thing. So I put together the numbers here. And if you're a numbers person, raise your hand. I know in our Fortune Builders community, we got more numbers people out there. So, oh man, I love that you guys are raising your hand. I'm a numbers person. Shiley's a numbers person. Madison, Pablo, we're all numbers people. And so I'm glad that this is going to emanate and resonate well with you. But what we're going to do here is we're going to look at reallocating $500,000 in retirement accounts into a portfolio of 2 rental properties. This is something that a client recently did for JWB. I want to show you what they saw and why they took advantage of this opportunity. The client came to us and they had money in their retirement account. And they said, you know what, I feel like I'm way too dependent on the stock market. That ring a bell for any of you? Of course it does, right? So there was $500,000 that they said, you know what, this is in my retirement accounts right now. It's in the stock market. I'm not liking the way that this is looking going into a potential soft landing or recession. What can I do to proactively diversify out of the stock market? So that was their investment priority there. And we talked about their horizon, their time that they wanted to be in this investment. And for them, of course, it's a long-term investment. If you're thinking about investing in rental properties, it should be a long-term investment. So for this client, it's 20 years. And so they sat down, they went to chatwithjwb.com. That's where all of this starts. It's a conversation with you. We get to customize a plan for you. They sat down and together we built a plan to take that $500,000 that was in stocks and bonds in their retirement accounts and keep it in their retirement accounts, but simply move that over to a better asset for them, which was a portfolio of 2 rental properties. And we bought both of those properties with cash, so 100% down. We did not use financing for this portfolio. And here's the beauty of investing in rental properties, right? You get paid multiple ways. In the stock market, you generally only get paid one way. It's through stock price appreciation. But in rental properties, you can get paid up to 5 ways, right? And so what I put together here is a 20-year outlook of how this investment is estimated to perform, broken down by profit center. And some of these profit centers might be new to some of you. So if you don't understand what some of these mean, Paul and I are happy to go into this. But through this next cycle, this 20-year cycle, this cash purchase of investment properties, 2 of them, would net out over $580,000 in net rental income. Shively, you want to give a quick synopsis of what net rental income is?
Yeah, I mean, net rental income is your short-term. Think of it as, if you're comparing it to a stock, it's your dividend, right? It's your cash going, now in this case, going back to the retirement account, right? You purchase these in the retirement account. It's that monthly income that goes back to the retirement account, post expenses, post management fee, all that kind of stuff, right? So think of it as your cash on cash return. A lot of people are used to hearing that. If you don't own any real estate and you haven't done this yet, maybe you're one of the newer Fortune Builders investors and you haven't done this yet, and most of your money's in the stock market, it's your dividend from your stocks, which most stocks don't have a dividend, right? Most stocks are solely what would be likened to home price appreciation down below, right? So this is your dividend. This is your monthly net cash flow hitting back to your account every single month.
There we go. So net rental income, your income coming in minus all of your expenses, taken into account things like maintenance cost and vacancy cost, tax savings, right? There's additional tax savings because this is in your retirement account, principal pay down of 0, Only reason that's zero is because we did not take a loan on these assets. We'll see in the next case study that I put together where we actually did take out a loan. We'll see that principal pay down profit center will be taken advantage of as well. And then you've got home price appreciation. Again, these are assets that are appreciating over time. Home price appreciation, for many people think that it's something they can't count on, but the data shows you that if you are a buy and hold investor and you look over full market cycles, those would be 10 to 20 years in real estate, things come back to the norm. The appreciation that happened over the last 40 years largely happens for 10 to 20-year segments going forward as well. So that type of appreciation is significant. It's something you can count on as long as you have a long-term outlook. As well, we are benefiting from inflation hedging and inflation profiting. Real estate does that. It's a hedge against inflation, whereas other assets like in the stock market by themselves are just not a hedge against inflation. So you got all those profit centers working together for you. And here's how it ultimately looks out. If I ran the return on investment numbers, and IRR is a scary acronym for many people, it's the preferred way to determine what your return on investment is. This client put in $500,000. All they did was reallocate money that was overly dependent on the stock market, now put it into this portfolio of rental properties. And over 20 years, they're going to earn just about $1.3 million from those different profit centers that we talked about. Their total portfolio is estimated to be about $1.8 million. And if you break this down as a return on investment, it comes out to just under 9% return, a consistent 9% return. So the diversification of getting out of something they were overly dependent in, and the fact that they can still earn a 9% return roughly, is the big reason why the client was attracted to this. What do you think, Shively?
Yeah, I think two things jump out at me. It's a great case study. I'm super, number one, pumped for whoever did this, right? Because I've seen the impact of this. I've done it myself. I've done it with my father, right? I've done it for my brother, and I've been doing it for that 5-10 year period already. And so I've seen the impact of this already and the change it's had and the amount of emotional satisfaction, but also freedom that comes with this, which is really nice. So that's the first thing. More on a teaching point, I think you said two things that I have learned over time that I wish I knew when I was getting started. I was very dependent and really laser focused on the cash on cash numbers. If we go back one slide, I was really laser focused on kind of my net rental cash income, right? My net rental income. I was super focused on that. And I made decisions really solely based on that. And I was in that camp early in my career, and probably for too long in my career, that I kind of disregarded and I wrote off appreciation. I said, I want to be extra conservative and throw appreciation out the window. And I would even teach that, be extra conservative and throw appreciation out the window. And what I'm telling you is I've evolved, I've grown, and I think learned from the mistakes I made, right? Early in my career is you don't want to discount that because there is data that supports that. And as long as you believe in data and math, which most of us as investors do, we need to not be ignorant to that and the impact it can have. And as you can see mathematically, it's a larger impact, and really a large portion of the wealth that real estate creates is that. And so I've learned to broaden my horizons and broaden what I'm looking at when I'm making an investment decision beyond just the cash flow, beyond just that net monthly income number and that percentage, and get that broader impact. And I don't want to skip over that part. I think it's really, really important. And I think most people, it's not average, which is why this show is perfect. It's not your average investment show, but you're also not going to get the average results, because if you're taking that into account when you're making a decision, then you're looking at the whole pie, right? And I've seen the impact on my family. Like my father's able to retire early because of that exact income source. There's 4 income sources, or actually 5 now that you've taught me, Greg. And that home price appreciation is the sole reason, because we bought properties for him 5-6 years ago and they've appreciated and we've reaped that and harvested that. And he's able to retire now. Like rubber meets the road. It's very, very simple when you break all this down. So that's the one thing I really want to hit and make sure we don't skip over, right?
I think it's a great point. I always ask folks the question, okay, sometimes people will say, I don't want to count on home price appreciation. I don't want to bank on home price appreciation. And I'll ask them what they're doing with their money right now. And a lot of them will have it in the stock market. And I'll say, why do you have your money in the stock market? Are you counting on stock price appreciation?
Exactly. It's the same thing.
And they'll say, well, yeah, of course. And what I point out to them is that you believe that there's going to be stock price appreciation because over a full cycle, generally there's significant stock price appreciation. Well, it's the same thing in real estate, just for many reasons, more emotional reasons than anything, because we all were burned in some way from the Great Recession and saw home prices fall. We somehow have a different set of standards for when we can count on it. But at the end of the day, it's cyclical, just like stock price appreciation. Home price appreciation is the same. And without that knowledge, you will not make as good of decisions with your money. Because you will be missing a significant part of the profit equation when it comes to real estate.
Exactly. And there's data that backs that up. That's the beautiful part. Please don't take our word for it. Please do not. There's data that backs it up, right? Do your own research, right? Our job is to fast forward your career. Our job is to fast forward your success, right? But ultimately, like, please don't believe us. That's good, because you're going to be a more educated investor when you go research and look at the same data we have, right? That's a good thing.
100%. And if you want to see the data, that's a great opportunity to reach out to
Absolutely.
our team as well.
We'd love to send it.
Yeah. So just reach out. We'll show you what the home price appreciation levels have been in a market like Jacksonville over the last 40 years, because there's just a ton of misinformation out there. So anyways, we would love for you to reach out, and I'm happy to share this data with you. Again, go to chatwithjwb.com. Would be remiss if we didn't talk about the growing cash flows for this investment over time. Another reason why real estate wins versus the stock market generally is that your cash flows are growing as rents continue to go up. Rents go up at a faster rate than your expenses go up. And so your cash flows grow, and it's nice to see 1 year, 20-year segments of time, even farther out, as we all start to think about retirement and healthcare costs, to know that you have a significant amount of your retirement income coming from rental properties, and it's not volatile to the degree that the stock market is, gives people peace of mind at night.